Hey, it's Edna Keep here. Welcome to the Seven Figure Real Estate Podcast. I'm your host. I hope you enjoy this episode. Hello, everyone. This is Edna Keep with Seven Figure Real Estate. And today I have with me Jason Hartman. I quote Jason a lot. He probably has no idea how much I quote him. So I was so excited to be able to bring you his knowledge on my podcast and my YouTube station. Welcome, Jason. I'm so excited to have you.
Great to be here, Edna, and I'm one of your few guests that have actually been to your town.
Yes,
I bet.
We talked about that beforehand. Yes, Saskatchewan's such a small area. When I mentioned it, like, is that close to Toronto? Or
I have been to Saskatchewan, unlike many
There's
people.
lots of great things about Saskatchewan, isn't there? Jason is from Palm Beach, Florida.
Yep.
So we kind of had a bit of an interesting discussion ahead of time, how we're both very pumped about Jacksonville right now. So, but anyway, one of the main reasons I wanted to bring Jason on is I've been getting his emails for a long time. I follow his YouTube channel. And if you're not, you should. And he's got a newsletter, I believe, called The Empowered Investor, where he gives us tons of knowledge. If you've heard me talk about that, I believe with the inflation coming on, that we're actually paid to hold our mortgages. Jason's the one I got that from. I listened to a whole YouTube video about that. But anyway, Jason, give us a little bit of background on yourself and how you got to be so knowledgeable about economics.
Sure. Well, Edna, I took economics in college, but for some reason, it wasn't as interesting to me then as it is now. I guess when someone is just self-interested and curious, that's when they're going to learn the most. So I really started I guess I've always been interested in the topic, but I started a real deep dive into it in about 2003, 2004, and tried to really apply some of these economic principles to real estate investing. Because, as I'm sure you and your audience will probably agree, as I always say, income property is the most historically proven asset class in the entire world. There's simply nothing better than income producing real estate as an investment. And, there are many characteristics of it that a lot of people don't really realize. They're happening behind the scenes, and some people sort of cut them short, something that would have been very beneficial to them had they done it the right way, right? And they might think they're doing it the right way, and they might be actually shooting themselves in the foot. So hopefully we can prevent that from happening on today's interview.
Well, I used to be a financial advisor, Jason, so I totally get what you're saying. Like, I didn't understand real estate at all. And people would come in and try to talk to me about it, and it was like I didn't know, and I couldn't even have a conversation with them about it. But once I understood real estate, I sold my practice because it was like I couldn't invest anywhere else. It just didn't make any sense.
No, there's really nothing better. It is a great asset class for sure. And, I got into it because I grew up poor in Los Angeles, and I saw an infomercial for a guru when I was 16 years old. And I got his book. I read 3 chapters, put it down. My mom read the rest, and she got interested. And then about 2 years later, she invited me to my first real estate seminar, and I went and got really inspired. I was only 18 at the time and decided I'd get my real estate license. And my first year of college, I had my license, and I was selling real estate part-time for Century 21. So,
oh, good for you. Who was the guru that you read his book?
Robert Allen.
Oh yes, No Money Down.
Way back in the day, yeah. And I bought my first rental property about 6 months into my career. I was only 20 years old, and just went from there. And it's been a great ride for many years. And I've had hundreds and hundreds of tenants, maybe over 1,000 now, or even more. I don't know. And lots of properties, and it's just been a very good investment. And I also have it as a career because I have a business that helps other people invest in real estate nationwide. And so we've been doing that, in different forms for about 18 years now. So, it's great.
Okay, perfect.
And
Well, I know that we chatted a little bit, and we're going to talk a little bit more about inflation, and then you've got a comparison chart you want to show us. So,
sure.
do you want to bring that up? And which one did you want to talk about
Yeah,
first? The
inflation,
Okay, let's
inflation,
do that.
and you know, I don't think we'll have time to do both, Edna, because
Oh,
it
okay.
takes a little while to explain this stuff. But I'll just tell you, since you alluded to it before we jump into the inflation
Sure.
topic, I developed a new economic index called the Hartman Comparison Index, or the HCI, and what that does is it helps people understand. If real estate is cheap or expensive, if it's overpriced and we're going to have a bubble that pops and everybody's going to get hurt, or if it's underpriced and we should keep on buying. So that's what the HCI helps people understand. And you know, since we don't have time to cover that today, they can learn all about that for free on my podcast, The Creating Wealth Show, or my YouTube channel. Just type in Jason Hartman and you'll find both. But what we'll talk about today, the index is newer. Okay, so that's a newer thing I've been talking about lately. But this one is an older thing that I've been talking about for, I don't know, 18 years probably. And I call it inflation-induced debt destruction. I know that's a mouthful. So try to say it 10 times fast. Inflation-induced debt destruction, or you could call it IIDD for short, I guess. And what it shows people, Edna, is it's a really cool technique that is really the hidden wealth creator with income property. And a lot of people don't even realize this is making them wealthy, but it is. It's working behind the scenes, and it is super reliable and super consistent. And it's just a great thing. So maybe we'll pull back the cover today and really show people what's happening, you know, behind the scenes with their real estate deals.
Sure.
So, you know, I guess when you understand inflation-induced debt destruction, you can really align your interest with the two most powerful forces the human race has ever known: governments and central banks. And you know what? I can complain about them all day long. I don't like what they're doing. A lot of people that are aware of what they're doing don't like what they're doing. But the fact is, they are way too powerful and nobody's going to stop them. Okay.
Yeah.
And when I say what they're doing, right, what do I really mean by that? Well, they're destroying the value of our currency, right? Whether it be the US dollar, the Canadian dollar, the peso, the Brazilian real, the euro, the yen, the ruble, it doesn't matter what currency. Every country is in a race to the bottom to destroy the value of its currency. Sometimes very intentionally, because it increases their foreign exports, like China. You know, Trump has accused them of being a currency manipulator. That's what he's talking about. They artificially suppress the value of their currency so that their exports look cheaper on the world market. And that works. You know, it can increase their export business, but it hurts their citizens because the value of their currency in their wallet, their savings account, whatever, it's less valuable when they go to the grocery store. And so that's inflation in essence. Okay. And this is happening all around the world. And look, there's an old saying: if you can't beat them, join them. Right? You've heard that saying.
Yes, I have.
We've all heard it. And that's the way it is with the governments and central banks. The US government, the Federal Reserve, any central bank in any country, any government, right? And so what we want to do is we want to understand what's happening to the governments and the central banks, and we want to use that information ourselves and align our interests with them, because they're going to do what they're going to do. They have an incentive to do what they're going to do, and we can profit from it. So first off, we have to understand that pretty much every government around the world is in debt up to their ears. They all spend too much money, pretty much. There's hardly an exception. In fact, I can't think of one, but I'm sure it's out there. You know, there's like 206 countries or something, right? So, you know, pretty much every country is essentially mismanaged. Okay. And they spend too much. And the politicians spend all this money to essentially buy votes and to make people happy so they can stay in power.
Mhm.
And so now that they've spent too much, what do? Right? What are they going to do to solve the problem of their debt, their huge debt problems? So I've identified 6 ways that they can get out of the mess.
Okay.
One way is the government, and I'm talking about the US government, but it doesn't matter. It's pretty much every government, right? Although the US is in a special position, and I'll talk about that in a moment.
Okay.
So they could default on their promises. They could say to people, look, we're sorry, all of the welfare benefits we promised and all of the national defense we promised and the medical care and, every social security in the US, whatever, right? We can't keep the promise. Sorry, we've just overspent. We just don't have the money. Sorry,
Mhm.
right?
Mhm.
Not likely, because we saw what happened in Greece and other European countries when they instituted austerity measures, right? That's what that is. People riot in the streets, and it's a big problem. And so an outright default is very unlikely. That's just not likely to happen. The other option is raise taxes. Well, this would have worked decades ago, but the problem is so big now that you simply can't raise taxes enough to solve the problem. There's not enough money to get. And if you do raise taxes, it's been proven over and over again that increased taxes ultimately suppress economic activity. So, you don't want to do that because it's like you're damned if you do, you're damned if you don't. It's not going to work, right?
Yeah.
And there's just not enough tax revenue to get. Eat the rich, tax everybody at 100%. Still won't solve the problem. The problem is far too large for taxation. Okay.
Mhm.
So another way is to sell off assets, right? Now, people might remember years ago when it was all over the news that the United States was going to sell its ports to Dubai, right? To the UAE.
Mhm.
And that didn't happen, but there was a lot of to do about it in the news, maybe, I don't know, 8-10 years ago. When we started for a short time, at least, I don't know if we're still doing it, selling military equipment, our high-tech military equipment to Libya, right? It was, considered a rogue terrorist state before that. But the more desperate the country gets, the more it will bend its principles and its morals, right? Because it's just desperate and it needs the money. Regularly, the Bureau of Land Management, the BLM, sells off land to developers, right? And so, like anybody, the U.S. has assets and it can sell them, right? But there are only so many assets, and you can't do that forever. That's not a business plan. Okay, it's not a long-term plan.
Mhm.
Okay, so what else could we do? We could use the U.S. military to steal the assets of other countries. Certainly, people have accused the U.S. of doing that. Whether it's true or not is subject to weeks and weeks of debate without any break. But whatever, right? That's the history of the world. Is the military, whatever. If you go back to the times of Napoleon, I mean, he was essentially a burglar with an army. That's essentially what the great military general Napoleon was. He was a thief. Okay, that's
Yeah.
history. That's
Yeah.
you steal people's resources, their land, whatever, right? So that's one other way. Okay. Or on the positive side, let me give you something positive. There could be some major technological innovation in energy, biotech, nanotechnology, whatever, that could just solve the problem, right? It could make everybody so prosperous that the problem is solved. Let's hope that's the way it happens.
Yeah, I like that.
But you know what they say, hope is a ship that sank. Okay. the likely way it will happen is this one: inflation. And why is inflation likely? Because it's a great business plan for governments and central banks. It's exactly what they want. And they're going to do it. And the reason they're going to do it is because when a country has debt obligations, it can pay those debts back in cheaper, deflated dollars if it creates inflation. And this is a phenomenal deal. It's a great business plan. So let's take this example. Say the US owes $1 trillion to China. Well, it's more than that now, but That used to be the number for a time. And if it inflates the value of its currency, meaning it reduces the value of the dollar by 10%. Now, this could happen in 1 year if there's 10% inflation in 1 year, or it could happen over 2 or 3 years, whatever, right? Doesn't matter.
Yeah.
10% is gone. That means the US now gets to pay China back in cheaper dollars. So $100 billion, 10% of a trillion, is now wiped out. Poof. It's gone.
Yeah.
So you get to pay your debt back in cheaper dollars. So I thought, well, we're doing this with real estate, aren't we?
Yes.
And that is inflation-induced debt destruction. The government does it. We should do it too.
Mhm.
And real estate investors have been doing it for decades. A lot of them didn't even realize they were doing it. Okay, so let's just understand inflation a little bit here for a moment. To understand inflation, we need to distinguish the difference between real and nominal. So real is the actual value of something. Nominal is the name of something. So if I had a $20 bill in my hand and I held it up and I said, "Hey, Edna, what's this?" You'd say $20 bill. And if it was 2021, you'd say that. But you'd also say that if it was 1970,
Mhm.
because it was called the same thing.
Yeah.
But the value of it is much lower today than it was 51 years ago, isn't it?
Oh, totally.
Yeah. So the name and the value are two different things. Okay, so that's one thing. We also need to understand that inflation is a pickpocket. It's a robber, it's a thief. It's the insidious hidden tax that destroys our purchasing power. And that's bad, right? It destroys the value of our savings, our stocks, our bonds, and even our equity in real estate. Think about that one for a moment. I mean, look, if we have a stock portfolio or a savings account and or bonds, and we have $100,000 worth, and if inflation is 10%, that loses value by $10,000. Okay, so that's bad. But
Mhm.
what about the equity in our real estate? Well, the equity in our real estate is also diminished by inflation, even though the value of the real estate could increase, at least in nominal, if not real dollars. So remember, inflation is attacking the equity. At the same time, it might be making the price of the house higher. They're different. Those are different things.
Mhm.
Think about it this way. If you didn't have any equity, the price would still go up. And if you had 100% equity, the price would also still go up. Right? It doesn't matter how much equity you have, the price will do what it's going to do on that
Mhm.
apartment building or that single family home. Doesn't matter.
Mhm.
Inflation doesn't care how much equity you have. Okay, except in that if you have equity, it's going to attack that and destroy the value of the equity.
Mhm.
But thankfully, after it destroys the value of savings, stocks, bonds, and equity in real estate, it also thankfully destroys the value of debt. And we just learned that because we talked about how China and so forth, right? It destroys the value of international debt or sovereign debt, but it also destroys the value of our mortgage debt. And so
Mhm.
let's look at a real example of that in a moment. It's the most powerful way to redistribute wealth. Most people think taxes are how you redistribute wealth. No, that's amateur hour. Inflation is the pro way to redistribute wealth. Why? Because number one, it's subtle. A lot of people don't notice it unless it's happening really fast. And
Mhm.
even if it is happening, you talk to the average person on the street, they don't understand it. They don't get it. Now, thankfully, more and more people are getting it. And, I attribute part of that, I think, to the rise of cryptocurrencies. I think a lot more people understand this stuff when I started really teaching it 18 years ago. There
Mhm.
was no Bitcoin 18 years ago, okay? And certainly there weren't any other cryptocurrencies. And after the sort of the Bitcoin movement came along, not that I'm endorsing Bitcoin, I think it's very volatile, very risky. I mean, I do own some because heck, if it goes way up, I don't want to miss out.
Yeah.
Okay. I don't want to have FOMO. I already had enough FOMO in that world, right?
Yeah.
But I don't think it's any great asset. I hope I'm wrong about that, by the way. I'd love it if it would take over the world. I think it'd be great, but I don't think I'm going to be wrong about that. Anyway, a lot more people understand it now, and that's great, but most people still don't get it about how inflation really works.
Mm-hmm.
Inflation redistributes wealth from lenders to borrowers because lenders loan money in dollars at today's value, but they get repaid at tomorrow's lower value. So the borrower benefits in an inflationary time. That's wonderful.
Mm-hmm.
It also redistributes wealth from old people to young people. Why is that? Why do you think? Any ideas?
Well, because they will inherit it eventually, right?
Well, inheritance is a good point, but this method is a pre-death inheritance. I'll put it that way. Nobody has to die to inherit this benefit, okay? And here's what happens. Most of the time, or at least hopefully, old people have assets. They have savings, they have stocks, they have bonds, they have equity in real estate, all the things that inflation destroys. And young people have debts.
Oh, yeah.
And inflation destroys the debts.
Yeah.
So it's an intergenerational wealth transfer without death. Think about that for a moment. Okay. It really is amazing. Yeah. Really is amazing. Okay. So are you ready for a real world example? This is not just some big theory.
Absolutely. I'm ready.
Okay, cool. Any questions or thoughts so far? Or comments?
No, this is really
skepticism.
Good. No skepticism at all. I've watched enough of your stuff I buy into this totally.
Okay, cool, good. Okay, so some of you don't see the visuals, so I will just describe to you. Up on the screen, if you're watching on Edna on YouTube here, you can see that. But if you're only listening to the audio, up on the screen, what we're going to be showing is a chart of 30 years of inflation from 1972 to 2000, the end of 2001, where someone would have got a 30-year mortgage in the US and paid the last payment on that mortgage 30 years later. Here's what happens. Let's start with 1972. In 1972, in the United States, the median house cost just over $18,000. And if you put 20% down, you'd get a mortgage for about $14,600. I'm rounding off a little bit for speed. And the mortgage interest rate way back then, 49 yeyears ago, was 7.37%. Makes it look really cheap today, doesn't it? Yeah. So it's 7.37%. So you borrowed this money. And by the way, this is not a theory. Millions of people did exactly this. This is a case study. It's not a theory. It happened to millions of people, not just in the US, but around the world, but more so in the US because the US has a very special real estate market because it has those wonderful 30-year mortgages. Because coming out of World War II and the Great Depression, the government really in the US decided that housing needed its own welfare program. So it created Fannie Mae and Freddie Mac, the secondary mortgage market. And that's the reason we have these very special 3-decade-long fixed rate mortgages that don't have to be renegotiated. It's an absolutely beautiful thing. So in 1972, a dollar was worth a dollar because no time had passed yet. For this house, in our case study, the mortgage payment on that house would be $101 per month to pay that $14,600 mortgage, $101 a month. Okay. So now that's 1972. We're going to fast forward 30 years and we're going to go to the end. Remember, 1972, a dollar is worth a dollar. And the payment on the house is $101 per month. So every month for 30 years, people lived in this house. They paid $101 per month. And let's summarize what happened. They basically paid over $36,000 in principal and interest on a mortgage of only $14,600. So to the uninformed person, it looks like they paid about triple what they borrowed. And most people think, oh, this is terrible. We're paying too much in interest. Pay it off early.
Yes.
We gotta pay one extra payment per year. We'll pay it off in half the time. Or if we pay the payment every 2 weeks, we'll pay it off in about half the time.
Yeah.
And a lot of people stupidly did that, and they missed out. Okay.
Yes. Mhm.
You're going to discover why debt is my favorite 4-letter word.
Oh. Soon to be mine, too, I think.
It should be everybody's favorite 4-letter word. Okay. So they paid $36,300 in interest. Now, by 2001, 30 years later, that dollar from 1972 was now worth only 24 cents. So remember, how much was their mortgage payment every month? 101. Yeah, it was 101, right? But guess what happened through time? That payment, even though they were still writing a check for 101 per month, $101 per month, every month, that payment felt a lot cheaper over time because inflation kept destroying the value of that $101. So by the time they made the last payment, the check still said $101, but the value of the check was only $24.
Yes.
Isn't that incredible?
Oh, it is. It
So,
really is.
so I remember when my mom bought her first house, I was a kid and she was stressed out. I heard her talking to other adults saying, how am I ever going to afford a mortgage payment that's $416 per month? That's what she thought. How will I ever possibly afford that? And you know what? 4 years later, that payment felt easy. No big deal. Okay. And it's not because she got a bunch richer. It's just because inflation made the payment a lot cheaper in real dollars, in real value. Okay. So the $101 payment is now only worth 24 bucks. So let's summarize what happened here. We borrowed $14,600. We repaid in nominal dollars in the name of them, $36,300. But in real dollars, after inflation provided us the real value of them, because inflation debased them, it stole the value of them, right? We only paid in real dollars $16,300 in real value. That's what we repaid over time. So that means the interest rate that we thought we were paying was 7.37%, but the effective rate after inflation-induced debt destruction, remember that's the phrase,
Yeah.
inflation-induced debt destruction, the real interest rate was only 1.06%. Now, in the US, I don't know how it works in Canada, but in the US, we have to do what those people on those late night infomercials, those cheesy people say, but wait, there's more.
Wait, there's more.
Because in the US, mortgage interest is tax deductible. Now, everybody's tax bracket varies a little bit, but just taking the typical tax bracket, okay? Remember, our interest rate went from 7.37%. Then inflation came along and made it only 1.06%, but then tax benefits came along and made it negative, you heard me right, negative, you mean below zero, yes, I do mean that, negative 1.16%. So literally, Edna, millions of people got paid to borrow money, not to mention that they've been living in this house for free for 30 years.
I know, that is
Now,
amazing.
Isn't that incredible? Yes,
is.
Incredible, right?
Yeah.
But wait, there's more. Again, what if you didn't live in this house?
Mm.
What if you rented it and you basically took advantage of the outsourcing trend and you said, hey, I believe in outsourcing. I believe in delegating. I don't like to pay my own debts. I want to get someone else to do that. Tenant, renter, you pay my debt for me. And you know what? Give me a little extra every month too. We call that positive cash flow. Okay.
Yes.
So what if the tenant paid the mortgage and gave you a little tip every month of $200? That might be the average deal that we sell through our network, something like that.
Yeah.
And by the way, you can find all those properties at jasonhartman.com. Shameless self-promotion. um, and what if that happened? Amazingly, you would be literally making better than infinite returns.
Yeah.
I mean, it's truly incredible. And
Yeah.
these are a few of the reasons. There's even more than this, but a few of the reasons income property is the most historically proven asset class in the entire world. There is simply nothing better. Now,
Mhm.
I know some people out there are probably thinking, well, I don't like debt. Or, what if something goes wrong? Well, the biggest thing that can go wrong is you owning your property free and clear and the economy having a downturn and you being stuck with it. And
Yes.
if you think I'm wrong about that, just look at the millions of people during the Great Recession about 12, 13 years ago who got all the benefits when they were in debt. And the
Mhm.
people who did the right thing, right, they got nothing. It's not fair. And the world isn't fair and life isn't fair.
Yeah.
And this is why I want people to align their interest with the powerful forces that run the country and run the world. Okay. And that's why, you'll definitely benefit from inflation-induced debt destruction because the government wants inflation. In fact, our Federal Reserve officially publishes a target inflation rate of 2%. And last year, without all the craziness that was going on, Jerome Powell, the Federal Reserve chairman, said, we don't even care if it's higher than 2%. Okay. And those figures are understated quite dramatically. Inflation is much higher than 2% in real life, but that's their official target rate. Okay. So,
Mhm.
yeah.
That was excellent, Jason.
Yeah.
You know what? Every time I hear that, because I have heard very similar. I probably watched the last video of yours 3 times to really get that to sink in. I love it. I love the even the name that you called it. It makes so much sense.
It's a
Inflation.
big mouthful. Inflation-induced
It
debt
is.
destruction. Yeah.
Yeah, but it totally makes sense. And that's something that I've taught that for years and years. Worst case scenario, you don't get cash flow, but your tenants just pay your mortgage off over
Yeah.
the time period that you hold it. Maybe you
But
did.
don't pay it off. Do my other plan, refi till you die.
Well,
That's
and
another plan I
yeah,
have.
but
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 that takes another half hour to explain.
at least their buildings paid for and all that. But yeah, a lot of people can't wrap their heads around, especially if there's any downturns. It's like, oh my God, what did I do
Yeah.
wrong? It's
The
just
the best thing you could
right.
have in the downturn is a high loan balance and a partner, a bank, willing to work with you. That's the best thing you
Yes,
could have in a downturn.
yes,
Yeah.
yes. People need to understand that.
Yeah.
Well, you know what, Jason, this was such great information. So tell us again, how do people, what's the best way for them to connect with you?
Yeah, thank you, Edna. So my main website is jasonhartman.com. That's just my name, jasonhartman.com, Hartman. And then, of course, I have a podcast called The Creating Wealth Show, and you can get that by typing Jason Hartman anywhere you get your podcast. And then a YouTube channel, as long as it's not censored yet. It already has been a little bit.
That could happen, couldn't it?
And you can find me on YouTube while I last.
Then you'll have to go underground.
Yeah, exactly. But when all that started to happen, we started putting my videos on all the alternative websites as well, like Rumble and BitChute and all the others, just in case as a backup plan. So
Yeah, you have to plan ahead for that. Well, you know what, Jason, this was an absolute pleasure having you on, and I definitely want to interview you again about your HCI. That totally interests me. I gotta hear more about that. So we'll have to book that again very, very soon. But thank you so much again for sharing all your knowledge with us, and I look forward to our next interview.
Hey, thank you so much, Edna, and happy investing to you and your listeners.
Okay, thanks, Jason.
Thank you so much for listening. It's my sincere intention that you got value from this episode. If you're interested in learning more about building your passive income through real estate, either by investing with us as a joint venture partner or as a student discovering how you can attract investors to your deals and build your own 7-figure real estate portfolio by helping others build their passive income, Check out my website, ednakeep.com, or watch my free masterclass at ednakeep.com/90days to 5K.